Hi everyone, my name is Jonathan Chan and this is my contest entry to the 2010 Raise the Rate competition sponsored by TIAA-CREF. You can learn more about the contest at raisetheratecontest.org. So to begin, the primary focus of the competition is to propose an idea to raise the U.S. savings rate to 10% in the next 2 years, which is nearly double where it is today. As the economic environment has changed so drastically in recent history, the need for greater retirement savings and a renewed perspective on savings in general has become more important than ever. My proposal is to incorporate personal savings rates into the current FICO credit scoring system that is already used by millions of businesses to make credit decisions today. The FICO credit scoring system is far and wide the most used analytical tool to determine consumer creditworthiness. It is widely known by almost any consumer that has ever applied for a credit card, house loan, or even a cell phone contract. Consumers have shown that they are willing to alter their behavior to improve their credit scores. By making their savings rate part of the calculation, they will be incentivized to save. It is these aspects of the credit scoring system that make it the perfect platform to greatly improve the national savings rate. To better understand why incorporating the savings rate into the credit scoring system is a useful tool to raising the savings rate itself, we must first understand what a credit score is and how they are determined. Simply put, a credit score is a numerical value that is used to judge consumer creditworthiness. It is calculated from your spending and borrowing history based on available records that past creditors have reported. The output is a number that typically ranges from 300 to 850. The higher the number, the higher lenders will view your creditworthiness. Creditors and businesses such as credit card companies and banks will use these credit scores to quickly judge your creditworthiness compared to another consumer. While these scores cannot fully capture your ability to pay back loans, credit scoring helps expedite the lending process significantly, which is why creditors like to use them. The current credit scoring system does not incorporate how well a person saves in the calculation of their credit score. It primarily focuses on how they spend, who they borrow from, and their consistency in paying bills. My idea to incorporate savings rates into credit scoring really came from my own goal of improving my credit score while I was in college. From a few online searches, I kept finding the same tips. The first was to just increase the amount of credit I had available to me by getting more credit cards with higher credit limits. The second was to simply lengthen my credit history by consistently paying my bills and ensuring that the credit bureaus were aware of my spending. Both of these ideas actually seem to promote spending, not saving. From doing more research on the calculation of a credit score, I realized almost all aspects of the system also promote spending. While the exact formula used to calculate a credit score is not made public, the pie chart to the right is what is believed to be an estimated breakdown of inputs into a credit score. Being a good saver does not come into the picture, even though I would argue that a better saver is a more trustworthy borrower. The biggest takeaway from the calculation of a credit score is that it does not promote saving, but it encourages spending. A good saver is not rewarded with a better credit score when they should be. In the next few slides, I will go over the basics of how savings rates can be incorporated into the credit scoring system, why this idea is unique and innovative, and why I believe my idea has the best chance at raising the U.S. savings rate to 10% in just 2 years. The first step to incorporating each individual savings rate into their credit score is to create a mechanism to actually calculate each individual savings rate and report it to the credit bureaus. I think this can be accomplished a few different ways. One approach would be to expand the scope of the tax system to be able to calculate savings rates. The savings rate can be calculated from the supplemental information submitted to the IRS and then reported to the credit bureaus. An alternative approach would be to give the authority to audit and submit savings rates to a financial tool like Mint.com. A tool like Mint could potentially determine a person's precise savings rate if given full authority to track payrolls, retirement account contributions, and cash accounts. Mint could also use credit reports to determine outstanding debts the consumer has. While this idea will require significant work, I believe the following gives it a distinct advantage over other ideas to raise the savings rate to 10% in just 2 years. 1. There is already an established infrastructure. 2. It promotes saving early because you don't need to spend money to start building credit. 3. It benefits consumers because savers will be rewarded with less interest on their mortgages and student loans, increasing their savings rates even further. And 4. This idea actually stimulates the economy because it emphasizes wealth-building spending, like buying a home or investing in education. Simply increasing the savings rate would hurt the economy because it reduces consumption. Furthermore, I believe incorporating savings rates into the credit scoring system will be the most effective solution to raising the savings rate to 10% because it is already widely ingrained in consumer finance and has shown its capacity to alter the habits of consumers who hope to raise their credit scores. A consumer's credit score is a crucial component of their financial history that impacts their ability to buy a home, lease a car, or even get a job. By making their credit score reflect their savings rate, it will make saving that much more important in all of life's big decisions. The scope of the established credit scoring system is also what makes it the perfect platform to raise a savings rate. The facts listed will show that few institutions exist that have the capacity and breadth to take on an endeavor as big as raising the savings rate to 10% in just 2 years. In conclusion, the recent economic events have shown that saving for the future has become more important than ever. From observing the trends of the credit scoring system today, I firmly believe that incorporating the savings rate into the credit scoring system will not only be an effective and efficient approach to raising the savings rate to 10% in 2 years, but will ultimately make the credit scoring system a better judge of creditworthiness. At the end of the day, it's all about incentives, and I believe this idea aligns everyone's interests and can effectively accomplish this goal without causing more damage to the economy. In closing, I would like to thank TIAA-CREF and Facebook for hosting this competition. Also, thanks a lot to Prezi.com for their great presentation platform. You should all definitely check it out if you ever need to make a presentation. Thanks a lot for taking the time to hear about my idea. I hope you will vote for me for the People's Choice Award. A little bit about me. Again, my name is Jonathan Chan. I was born and raised in New York City. I just graduated from Northwestern University this past June with a BA in economics. I'm currently in New York working at my first job. Thanks again, and if you have any questions, feel free to post a comment. Thanks.